Hi, this is Vicki Suter, and welcome to the Profit Builder blog. And today we're going to be talking about how to use your financial reports as a powerful management tool. Have you ever found yourself in a situation where you look at a financial report, maybe it's a profit and loss statement or a balance sheet, and you just don't feel very confident about what the numbers say? Like you're not sure about how to read it or how to use that information in a useful way. I just want you to know you're not alone. I hear this from people, and I have for many, many years, business owners and leaders just like you who, we think that because we've been in business for a long enough time that I hear this a lot too, where people go, well, I should know that, or I should have that sense of confidence or clarity about how to use my financial reports. Or, I only use them and look at them when I have to do my tax return, because there's not that sense of really knowing why you want to look at them on a regular basis. And I want to just talk about that for a minute, because the truth is, when we don't know the results in our business, what we end up doing is we spend a lot of time worrying and wondering if it's going to all turn out. There's that sense of angst and fear of not knowing, which then has that underlying current constantly be in place where we worry about it and we think about it 24/7. That's what comes from not looking at your results and not seeing in black and white where you really stand in relationship to where you want to be. And one of the things I always say is if you can see it, you can do something about it. So that ability to be able to see that gap and what that gap is that exists between where you are and where you want to be, while sometimes that can feel disappointing, the truth is it is your key to being able to have a greater sense of peace of mind and freedom to know when you can stop worrying. Because when you can see how much the gap is, you can more proactively take actions to close that gap and get back in track with where you want to be. What I want to talk about today is how to read your profit and loss statement in a way that you understand what are the most critical numbers to look at and how to use it as a powerful management tool. What I have here on the screen is an example of a profit and loss statement. I'm just going to walk you through what each of the sections mean and what are the numbers that you would want to pay attention to. So the first section on here you can see is income, and that's the number that everybody pays attention to. We always have a revenue goal or an income goal for the year, and that tends to be a number that's pretty straightforward, right? That's how much did I bill or how much services did I deliver and charge for during the course of a year. And then your second section is your cost of goods sold. And cost of goods sold represents what are the costs directly related to producing that revenue. So if I'm a contracting company, that includes my labor, gross wages, any taxes or benefits or other costs related to having that employee. That includes subcontract expenses, workers' comp insurance, liability insurance, and any other fees and costs directly related to producing that work. By definition, that's what your cost of goods sold is. So one of the things that as you're looking at your own financial reports, you're probably going to want to make sure that your cost of goods sold represents all of those direct costs for producing that revenue within your cost of goods sold. The third section on here is your gross profit and your gross profit margin. So I'm going to make the distinction between those two. Your gross profit is simply the difference between your income and your cost of goods sold. That's your gross profit. In other words, that is the profits that you're making directly from the work that you're producing. And then your gross profit margin is your rate of return. So margin, by definition, simply means a percentage. That's all. When somebody uses the expression margin, it simply means it's a percentage. And percentages are what I call the great equalizer. So why the great equalizer? Because revenue can go up or down, but my margin or my rate of return should stay consistent. So in other words, if I'm doing $1 million worth of work this year and I have, well, we use this example, $976,000 in income, and I've got $581,000 in expenses, that if next year I do $1.5 million 5 in revenue, my expenses are going to go up proportionately because it's going to take me more labor or subs or whatever to deliver that revenue. The rate of return in terms of dollars or gross profit dollars will go up from this 394,000 that shows here. And it may be that it's 550,000 next year. But the gross profit margin, you want to stay consistent from year to year, because gross profit margin in the contracting industry is a critical number that lets you maintain and manage a consistent profitability on your bottom line. So the 3 things that we've talked about so far is revenue, income, what you've billed, your cost of goods sold, the cost directly related to producing that revenue, your gross profit or the rate of return in your gross profit margin on the work that you've produced. And again, this is for a period of time. I happen to be measuring this for an 11-month period of time. And then I have overhead expenses, which is the next section on your profit and loss statement. This is oftentimes called expenses or overhead expenses, and this is the cost of running your business. In the distinction between overhead expense, your cost of goods sold up here that we talked about a minute ago, and your overhead expenses is that cost of goods sold is variable based on the revenue that you produce. Your overhead expenses tend to stay more steady. Now, obviously, if your revenue goes up dramatically, so will your overhead expenses. You might have more office expense or, more employees. But proportionately, when your revenue goes up, your overhead expenses don't necessarily increase at the same rate that your cost of goods sold does, which is the way that we end up making more profit on the bottom line when we do more volume. So your overhead expenses are things like, advertising, fuel, gas, it's legal and professional fees, it's things like your salaries as an officer, it's your, office manager, your, maybe your estimator, right? All those salaries that are in there. And then we've got things like rent and utilities and so on and so forth. So your cost of goods is representative of the cost of actually producing the work. Your overhead expenses represents the cost of running your business. And those costs are more fixed in nature. Cost of goods sold are more variable in nature. So then you've got total expenses, total overhead expenses, and then your net income. So your net income is the difference between your gross profit and your net and your overhead expenses. So in this case, that's 14.27%. Again, that's my rate of return. Now, what do you do with this information? That's really the question. So one of the things that I say about numbers is that numbers in and by themselves don't mean anything. A lot of us have a revenue goal. So if this was my company and I had a revenue goal of $1 million, I was 11 months into it, I'd go, man, there's a pretty good chance I'm going to meet my revenue goal. Woohoo, that's really great. And if I didn't have a goal for anything else on here, then these numbers may or may not be all that great. So what do I want to compare it to? Well, there's 2 things that I would recommend that you compare your numbers to so that they have more meaning. One of them is to look at them in relationship to the prior year. So some of the other information I have here on this screen is the prior year, January through November 2017. Last year, this company did $610,000 in revenue, which is $365,000 less than this year. Now, all of a sudden, $976,000 in revenue means something different, right? Now I go, wow, that's awesome. I am $365,000 ahead of where I was last year. And then when I come down here, of course, if I look at my expenses, my cost of goods sold, they're going to be higher than they were in 2017 because I did $300,000 more in revenue. Remember, my cost of goods sold is always going to go up in relationship to my revenue. So naturally, those costs are going to be higher. But what's the most important number I want to pay attention to? I want to pay attention to that gross profit margin or that rate of return. my ROI. And when I look at gross profit margin, this year I'm running at 40.46%. Last year we were at 39.88%. Pretty close. So when I look at the difference between those two, I have roughly, 0.75% higher this year in gross profit margin than I had last year. That's also good. So far, when I look at this and I compare these two, I'm going to be probably pretty pleased that I've done $365,000 more this year than last year, and that my gross profit margin is staying steady and even a little bit better than last year. So now, doesn't that give your numbers more meaning, right? When I look at it comparatively this year compared to last year. And now when I go all the way down, I'm going to look down at where we are in terms of overhead expenses. Well, last year we were at 185,000. This year we're at 255. So I've spent 70,000 more to produce that 395,000 more in expenses, in revenue. So when I look at the bottom line, we're at 139,000 net profit, 58,000 in operating income last year. So net operating income this year compared to last year, we're $81,000 ahead of where we were last year. That's excellent. That's really great. And net profit wise, last year we were at 10% net profit margin, and this year we're at 14%. Again, went up 4 percentage points. That's huge. That's a wonderful number. So all of those look like super healthy numbers. Let's talk about these percentages. When I go down to overhead expenses, I'm going to go all the way down here to the bottom line. Last year, so this is interesting because last year expenses were $185,000. This year they're $255,000. You look at that and you go, well, there's a $70,000 increase. However, overhead as a percentage of income last year was 30%, and this year is 26%. So remember I said percentages are the great equalizer. What you can take from this is that it's 4 percentage points less it took to produce that revenue in terms of overhead expenses, and that 4% went directly to the bottom line. So you can see the difference. Last year, the net profit was 10%. This year is 14%. So paying attention to those percentages can be good because sometimes, when you have a growth year and you look at, well, our revenue grew, so everything else grew. But if this percentage had gone up to 33%, then what I would say is maybe you are not being efficient with your dollars that you spent in overhead and you need to cut back on those costs. So just something to look at. Now, when I look at the bottom line, and this says 14%, last year was 10%, how do I know what's a good percentage? Well, let me just talk about this for a little bit. So included in your overhead expenses should always be the compensation of the officers and the principals of the company. Super important to get an accurate beat on these numbers to make sure that there's adequate compensation included in there. So if you're a sole proprietor, what I'm going to say next is going to be different than what I would say is the average for people that I work with. So when I look at net income and I look at this percentage of 14% or last year at 10%, I'm going to say that in my experience, a company that is well run has a net profit of 8 to 10%. A company that's really well run, and I will say specifically contracting companies, construction companies, interior designers, these are companies that I've worked with for a lot of years. And as I've looked at numbers, and this has also been validated by some statistical data based on information I've gotten from CPA firms on studies that they've done. Well-run companies, 8 to 10% net profit. Really well companies, 10 to 12% net profit. And again, that's after officer compensation and all of the interest and expenses, and that's pre-tax net income. In this particular case, this company happens to be an S-Corp, so their taxes are not showing on the profit and loss statement. But if that was showing on here, then we would look at net operating income before taxes. So that kind of gives you a benchmark of what you want to look at when you're looking at a profit and loss statement, to be able to say, hey, am I running, is this efficient or is it not efficient? And where do I maybe want to make some adjustments in order to increase that bottom line? So the net profits of your company are what goes into building cash reserves in your company, giving you the ability to make reinvestments back into your company for assets. It allows you to have money to service debt, as well as, in the case of this company, to have money to pay out to the principals, to pay for taxes, as well as other profit distributions in the future. Setting a goal around that number becomes very important, because it's the thing that can take away all of that angst and all of that concern in terms of having the cash that you need in your business to be able to support you in your growth and to help you grow, thrive, and prosper. Now, there's one other number that I want to talk about on here, and that is your overhead break-even percentage. And I've done other blog posts about this, and there's an article on my website called Go Beyond Break-Even that will explain this as well. But I'd like to point it out as we're talking about profit and loss statement and numbers you want to pay attention to, because this is a number that represents how much do I have to mark up my bids just to break even, to make nothing on the bottom line. That's a critically important number to know, especially as you're looking at your profit and loss statement, because a lot of people get this number incorrect when they calculate this for their own company. You'll notice that this number for last year says 50.54%. And you might look at your profit and loss statement and say, well, my overhead percentage shows on here is 30.38%. But that is as a percentage of income, and that's not how you calculate your overhead break-even percentage. That number is calculated by taking your overhead expenses and dividing it by your cost of goods sold. So you see how it's dividing that for 2017 into cost of goods sold to 367. And that's how I came up with that number. This year, I am calculating that same number, taking my overhead expenses and dividing it by my cost of goods sold. So one of the things that you can see right away is overhead break-even percentage went down by nearly 7 percentage points. That's awesome. That's what you want. You want to keep your overhead break-even percentage lower, which that requires managing and controlling those overhead costs. So I just wanted to point that out. If you want more information about it, by all means, go check out my article on my website called Beyond Break-Even. So those are a couple of ways. So that's how you read and use your financial reports, is use them as a tool to be able to see where you stand. One way to compare numbers is looking at this year compared to last year, like we just did. Included in this blog post, I have given you an outline for how to read your financial reports that you can take back and use to go through as you're looking for your own company and looking at your profit and loss. So I hope this has been helpful for you. As always, feel free to reach out to me if you have questions, and I wish you all of the best in growing, thriving, and prospering. My passion in life is helping contractors build more sustainably successful businesses, increase their profitability, reclaim their time, and find more joy in what they do again. So if you found this video helpful, would you just share it with a friend? Thanks. I look forward to seeing you next time on The Profit Builder.